Good morning, everyone. Welcome to this update for global stocks and commodities for the 29th of March. Clearly, we're still in the middle of a firestorm and no one knows how long and how it's going to play out. But there is a roadmap forward in general terms that comes out of this because markets are now being driven very, very heavily by sentiment and emotion, and human emotions are pretty predictable at the extremes. So there definitely is a blueprint for how this unfolds, not precisely, not in detail, but certainly in broad terms. So that's what I want to examine this week and just look at how we can use that to advantage. So one of the things I want to do is something that I do once or twice a year. I've done it many, many times over the last decade, and that's go back and just look at the history of 2000 and 2008 and how crashes play out and where the opportunities are to get yourself out of the way and then to later on take advantage of those opportunities. So I think it's worthwhile revisiting that this week. The most important thing is understanding that each individual, to a degree, is going to be best suited by having a game plan for them. And so therefore there isn't one universal size fits all. All I'm trying to do in this weekend video is to give you some broad principles to help you think through what might be best suited for you. At the end of the day, I can help members, more directly with more of the detail around that particular game plan. This is the normal stock and commodity trend update, and really it's about reorganizing portfolios, making sure that you've cleaned out the cupboard, got rid of the poor quality stocks, the stocks that are at risk, because there's going to be many now that are going to be caught out, and getting your portfolio cashed up and in as good a condition as it can be. So let's look at it first of all from the fundamental side. There are just so many unknowns, it's ridiculous. It hardly even bears thinking about. So the E part of the PE ratio, so the earnings part, is very largely unknown. I don't think there's a company anywhere that really knows how this is going to play out for them. They're withdrawing guidance. In the most part, they don't know how to doubt. They know that earnings are going to go down. They have no idea by how much, and so rather than try to put out some sort of reduced earnings figure, they're just withdrawing guidance altogether while they see how this develops. There's probably no question that earnings are going to be lower for a period of time. We don't know what that period of time is, and it will be very different for different companies. So the critical part here is choosing companies that have got the balance sheet strength and the cash flows to get through this, however long it takes. So that's really the only thing that we can focus on. So again, as I stress each week, let's just focus on controlling what it is that we can control. And we can control analysing companies in terms of their cash and their debt and their cash flows. Because those prices, particularly if they've been beaten down heavily and a company's in good shape, and there's plenty of them, those prices are going to rebound pretty powerfully when we get to that point. So they're the companies that you want to know about. Now let's look at it from a technical point of view. It's virtually certain that there will be spectacular rallies and declines at the index level over the next 3, 6, possibly even 12 months. It depends on how long this virus lockdown occurs. But that is what's going to happen, because that is just human nature driving the market. We're not going to continue to just go down in a straight line. Second point is that the time and the shape of that pathway depends very much on how long the global lockdown goes for. They're talking in the US of maybe shutting New York down for 2 weeks. Who knows? It could be longer, it could be shorter. We just really have no idea at this stage, but there will certainly be tremendous rallies, as we saw last week. One of the probably the fastest 3-day rally in history occurred last week in the US, and then we'll get further declines. So there's little doubt about that. Now, many stocks will follow the path of the index, but many will not. And let me just interrupt here and just show you a couple in Australia that didn't. So there's the S&P. I'll come back to that. So you can see just the enormity of the decline. Let me just pan back a little bit further so you just get a sense of the abruptness of that decline. Now let's look at a couple of stocks in Australia. One of them's A2 Milk. It has virtually gone up during this period since the start of February. The price has risen. Let's not worry about why that is, but and this isn't a recommendation by any means, it is just an illustration that not all stocks behave in the same way. So you should not think about the market as just one overall entity. You're either in or you're out, because there are certainly opportunities within that. Let's look at Fortescue Metals. They're probably they're down a bit, but nowhere near like the index is down, nothing like it. So it's really important to understand that there is an index pathway that's unfolding, but then there are varying pathways for different stocks, and we can certainly take advantage of that. The index pathway will drive sentiment for all stocks. So if the index pathway is sharply down, then we're probably not going to see some of these really good stocks rebound very much. They may not go down, but they probably won't rebound. So there is this sort of overlay that the index pathway will have, but it doesn't necessarily need to drive individual stock prices in that direction. Now, whether we end up with higher ultimate lows if the lockdown ends quickly, or whether we end up with new lows if the lockdown stays in place for longer, is anybody's guess. We have absolutely no idea, because that's really down to government policy, really. And that's a very fluid thing at the moment. But I can tell you that the volatility will progressively settle down, and therefore it will become easier to navigate. At the moment, it's really difficult to navigate through these ups and downs, but it will get easier as the months progress. It's highly likely that gold stocks are going to repeat what they did in 2008, and that is they will bottom before the overall index bottoms, and they'll probably go up spectacularly. I'll have more to say on gold stocks when we get to that section. And some stocks, probably not that many, but some stocks will rise against the index trend, and we've already seen A2 Milk as an example, and I could probably give you a few dozen examples of stocks across different sectors that for various individual reasons are being supported by the market. So the next thing is, how do you play it? Because it's one thing to observe it and say, well, that's nice, that's how it's going to play out, but how do we actually go about taking advantage of that? And the most important thing is that you've just got to get clarity for yourself, what is suitable for you. Some people are long-term investors, others are quite open to being more active in the shorter to medium term. So the first thing that I would strongly recommend is that you just get clear about who you are and what your time frame is, because that really dictates the general approach that you should take. So if you would consider yourself a long-term buy and hold investor by nature, then you probably should avoid buying for most of the rest of this year, with a few exceptions. So the sort of stocks that I just pointed to before, because I think there's a very reasonable chance that we haven't seen the ultimate lows for 2020 yet. I'm not saying we have or we haven't, but I'm just saying that the probability now is that we have to allow for the possibility of the market going down and forming lower lows. And so therefore, if you're a long-term buy and hold investor, 2020 is certainly a time that you don't want to be jumping in too soon. The issue that I have, though, and this gets back to human psychology, is if you're a long-term buy and hold investor and you decide that you're going to stay out of the market for a fair part of 2020, the violent rallies that we are going to see, and we saw one just in 3 days last week, are going to put pressure on you to want to buy, because just about everybody's got a fair bit of damage done to their portfolio, and you want to repair that. And as the market goes up and up, initially you can resist, But then as it goes higher and higher, the pressure for you to buy and jump in and participate gets more and more. And if you succumb to that, then guess when you tend to buy? You tend to buy when the market has probably had its rally and it's about to go down again. So this, the practicality of doing that is actually not as easy as you might think, and that's just, step out of the market for a while. I think you should use the rallies to reduce poor quality stocks in your portfolio. So use it as an opportunity for house cleaning and get rid of some of those poorer quality stocks and set yourself up for the ultimate rebound at a general level. Now, if you're not a long-term buy and hold investor and you want to repair the damage sooner, which I think most people will want to do, then you need to know and learn how to attack the rallies and be more active, because some of these rallies will go quite a big distance and they will go for quite a decent period of time, be it weeks or months, and then there'll be another downturn. So they're very tradable and they can be very profitable. So there's no reason for you to stay out of the market. So, but the first thing is you just got to get clarity around this for yourself and decide, and then stick to it. So let's look at the actual markets. The S&P rose by 236 points for the week, up 10%. So at least some degree of recovery, but it always happens, and it's certainly not the signal of that we've got the all clear. There was a spectacular three-day rebound when the stimulus, ultimately $2 trillion worth of US stimulus was being thrashed out. And then we got a weak finish on Friday when the markets turned over. That is also pretty normal because traders just don't want to be long going into the weekend. 2 days is a long time in this world we're in at the moment, and they just wouldn't know what government announcements or change in policy might occur over the weekend. So the fact that we gapped up on Friday in the US and then reversed back is pretty normal. The virus progression will determine the bigger picture, so how long and how deep. But it's the technicals that are going to drive the short term, because computer algorithms are still a very significant part of the market, and they're going to have an outsized influence. And they're taking their cues off the technical patterns. Now, what I want to do is consider other crash periods and how they progress. So let me just do that initially, because I think that's a very worthwhile exercise. I've done it, as I said, numerous times before. So let's go back to 2008 and look at how things unfolded. And it'll give you a sense of why this time was so very different. Okay, so here we are through 2007. We formed a peak. The ultimate peak occurred in October of 2007. We had a previous peak in July of 2007. Now, at this point in time, you can see the red line, the 200-day moving average, was still heading up quite strongly, and the price was robustly above that moving average. Now, some people are claiming that this time, we should have been clairvoyant and we should have seen that, the market was getting extended and that we should have got out. But you could have said that throughout 2005, 6, and 7 in the US. So, you can't get out until, in my view, you can't get out until the market tells you that it's actually the time to get out of the market. Because if you'd done that in 2005, or 6, or 7, you would have got out way too early, because you would have got out here, or here, or here. And so ultimately, even though you may have incurred some damage at the start of the GFC, you still would have ended up getting out at a much higher level of the index than if you'd done it years earlier. So it's all very good for these perma bears to be very smart after the event and say that you should have got out earlier, but practically it just doesn't work that way. So we reached a peak in July. We then got a bit of a change of character. So this was the first warning shot across the bow that maybe things were changing, because we went deeper under the 200-day moving average than we'd gone before. But then we got a very sharp rally, and we actually formed a slightly higher high. That was into October of '07. Now, we then started to get lower highs, and we got lower highs. So really by December, it was starting to become evident that the character of the market was changing. The index was now spending more time below the 200-day moving average. The 200-day moving average by December had started to flatten out, and so it was pretty clear that something was changing. Now, at this point, we didn't know to what, but at least you were on notice that some things were perhaps changing. Now, for me, the ultimate notice was occurred in early January when we broke these lows. So we broke this closing low here, and we broke this low here. So I was being driven by the charts, and I indicated at that time that, and it was probably a few days later, it was probably down here in this area. So we're talking around about just under 1400 on the S&P. That, you certainly should be starting to maybe cash up a little bit. There wasn't any need to panic at this stage, but you really should be, pretty careful about any further buying. Now, we then got, as you can see, further periods of rallies, plenty of opportunity to get out of the way. So from early to mid-January through to about June. So there was nearly 6 months worth of opportunity to make adjustments to your portfolio. And then after that, it was all pretty much downhill. And we descended to an initial low in the middle of October. We got a bit of a bounce. This is when the gold stocks bottomed, and then we went lower for another 4 or 5 months after that. But the point was, in a normal crash, if you go back through any crash period, you get these rebound opportunities to make adjustments, and you normally have many, many months in which to do it. Roll forward to where we are here, and because this is something that's never ever been seen before, we didn't get that opportunity. The market effectively, perhaps you could argue that we got this opportunity here on these couple of days, but look, the moves were just so quick. They occurred in the matter of hours and days rather than spanning over 3 to 6 months, that it was very, very difficult to get out of the way. And so that's brought us to where we are now. That's history. We've now got to make the most out of repairing the damage that has been done. So I've just put a Fibonacci scale here on the decline from the peak on the 20th of February, and you can see that some signposts to look for, rebounds to around this 38.2% level, the 50% level. If we were to get to that, that would be a much more positive sign if the market was able to rally that far. So we're still in this extremely difficult period where we had a rapid decline. We've now got a violent rally. We don't know whether that rally's finished yet. And so this is still a tough period to trade. Once this goes up and then comes back down again, as it almost certainly will, then it starts to become progressively easier to navigate our way through that, and that is where the more active process of using these rallies and troughs to advantage starts to kick in. Okay, so there's no question the US is in trouble with the virus, but the conversation coming out of Washington is that they're going to try and lift these bans far more readily than other countries are talking about. When Scott Morrison enacted the bans in Australia, he made it very clear these were for 6 months as a minimum. So that was their thinking straight off the bat. America seems to be thinking maybe it's just Trump, but America certainly seems to be heading in a different direction, and that is they're not going into this with a long lockdown mentality as many other countries are. So they're likely to try and lift the lockdowns quicker than normal. And this is probably one of the biggest gambles in history, because I think Trump probably realizes if he has a long lockdown, he has a huge recession and he is not going to get re-elected as president. So he knows that that pathway will not get him re-elected. So effectively what he's doing is he's gambling on the fact that we'll limit the economic damage, and we'll hope that the human damage is not too great. If he pulls it off, he's a hero and he'll get re-elected. If he doesn't, it'll be the biggest gamble in history that failed. So it's going to be extraordinary to watch over the next 3 to 6 months. Now the US dollar plunged again, got up to 103. So safe haven money flooding into the US dollar. Part of that came out, particularly with the US stimulus package of $2 trillion. So we ended up back at 98.3, which is about where we were prior to all of this starting. 10-year yield, pretty volatile, but ended up fairly steady in the end. And of course, just a huge spike in jobless claims announced on Thursday night. Let's look at a couple of charts. This is the spread between junk bonds, so high yield corporate bonds, low quality, and government securities. So you can see that normally the spread was sitting somewhere around about 3.5%. If you go back to the GFC, that spread got out way out to in excess of 20%. So if the government bond rate was say 2%, then the average corporate high yield bond rate was in excess of 20%. So that was the difference between the two. So you can see that this has only just started to spike, and this is what the government is trying to head off. This is what a large part of that $2 trillion stimulus is about. It's to try and stop what happened in 2008. So we get this massive blowout in the junk bond market, which leads to corporate bankruptcies. So it's early days on that one yet. And this was the spike in the jobless claims, as you can see. It's just never been seen before. I think that chart really says it all. Looking back 50 years, it's jobless claims have never ever spiked like that in history. Let's look at Aussie stocks. Our dollar finished. We were down at 55 a week ago, but we're up at 61.7. We had massive volatility over the week, over a range of 4.5 cents, which is really pretty extraordinary under normal circumstances. The ASX 200 index rose by 22 points on the week, about 0.5%, but we'll probably start off lower on Monday. But look, who knows? Anything could happen. These markets are just going backwards and forwards with such incredible speed. On Friday, we saw the Friday burst that petered out again, so very much the same as the US. Investors and traders just don't want to be long over the weekend. So we're certainly seeing a lot of short-term trading. We seem to see this almost every day. There is huge selling and buying on the strong days in the match period. So in the Australian market, for those that don't know, there is a period between 4:10 when the market closes, between 4 o'clock when the market closes, and then 4:10 when prices are actually matched off and the final prices are determined. So it's called the 10-minute match period. And there has just been extraordinary moves in that period. The index could move 2 or 3% in that 10-minute period. You need to be very clear about what your targets look like. Now, that might seem a strange thing to say, but you can certainly get clarity around that. Are they large caps? Are they small caps? What industry sectors are they in? Et cetera, et cetera. Do they have very strong balance sheets, or are they high dividend payers? There's a whole lot of parameters that you can build around what your targets look like. So let's look at the Australian market. First of all, I'll just check in with the US dollar. So there's the extraordinary fluctuations in the US dollar since the 20th of February. So fell apart, screamed up, and now back down again. The Australian dollar has sort of mirrored that in the inverse. But we're still obviously in a very, very steep downtrend at the moment. For the record, there's the Australian index. So you can see with this long tail on the top, we traded up 3 days. We were trading higher on Friday up until probably a couple of hours in, and then the market turned around and finished way down on its lows. And it's just really hard to know. We've broken that key support on the ASX 200, you'd have to think that that 4,000 points is quite possibly in play, and that's nearly 1,000 points lower than where we are on the index at the moment. Okay, let's move on to precious metals. Gold rose by $123, so we're back above 1,600. Was partly helped by the US dollar coming off, obviously, but of clearly strong buying, quite apart from the currency. This is the perfect environment for gold. We've got nil to negative nominal interest rates. We've got certainly negative interest rates in real terms almost everywhere. So that's one really key plank for gold. Secondly, we've got a financial crisis building. At the moment, it's a health crisis, but if we stay in lockdown too long, we're going to have a financial crisis. So that's a good environment for gold. And thirdly, we're certainly to a part of the cycle where gold has got upward momentum. The trend has changed. It's been in an uptrend now for well over a year, and so really everything is pretty much aligned for gold. It's now just the when. Now the when is only being held back by the selling, the forced selling that's going on. So we're not quite sure when the when is. You could certainly be justified in starting to build some gold exposure now. And then that, of course, leads on to the how. How do we actually go about doing it? How do we stage our entries into the gold market? And that's something that I'll certainly be keeping members abreast of. Now, when we look at precious metal stocks, profits are absolutely soaring. They were going up at a rate of knots before the middle of February, and the outlook for those stocks couldn't be much stronger. Now, that's the profit side. Now, in the very short term, in Australia, we've got companies withdrawing guidance. We've got uncertainty around whether essential workers will be given more freedom of movement to get to the mine sites or not, or whether mine sites will have to shut down. That's a moving feast. My personal view is I think the government will probably create or provide some exemptions there because, mining exports are just such a critical part of our economy. But we've certainly got uncertainty from an operational point of view in the very short term. But removing that and removing the forced selling, which is coming from other asset classes, then the outlook for precious metal stocks really is extremely positive. So as usual, as I always recommend, you just got to get a coherent plan. You can't approach this market or any market on the basis of just picking up shiny little objects when there's a bit of a bounce, or you might read something in the press. It's just, you're going to get yourself into trouble if you do that. You've got to sit out and nut out a coherent plan. If you don't know how to do that, then that's something I can assist with. But look, if you don't have one, you're running a huge risk. All right, let me look at the gold market. So there's gold on a daily basis. So you can see we had a very, very powerful rally that started on Friday the 20th and went throughout the rest of the week and held up pretty well. So you can see the massive rebound even though the US dollar was coming down. Let's look at the weekly just to give you a sense of the volatility. So this last 3 weeks really has been quite incredible, or really the last 4 weeks, I guess. So that's the gold market. Now from now on, I'm going to stop looking at GDX. I'm going to look at GDXJ sorry, I must have cut that one out. All right, so this is GDXJ. Now the reason I'm going to look at that is I think it's a better representation of the sorts of gold stocks that most people are going to trade, because whilst this used to be the domain of junior miners, it's actually changed a lot. And companies like, Australia's actually got three entrants in the top 10, Northern Star, Saracen and Evolution Mining. And it removes the drag from the really super major gold miners like Barrick and Newmont and Newcrest, which really don't have a great track record over the last 10 years. They've made some bad moves at the wrong time. So I'm going to start looking at GDXJ as a more accurate reflection of what we should be trading. And we've actually seen GDXJ outperforming over the last year or so. So at the moment, we had an uptrend. That uptrend has been punctured by forced selling, but that will pass. But as you can see, it's still terrifyingly volatile. We've gone from 46 to 20, back up to 36. So this is why you need a coherent game plan. If you don't, this will give you heart palpitations, I'm sure. But the longer term outlook for gold stocks looks really good. Other commodities, copper down slightly to 215. With all these commodities, it's about demand, and demand has collapsed. Crude oil down again, 2160, and again, massive drop in demand and a huge lift in supply at the same time because of the OPEC Russia thing. So it's a very, very difficult situation for energy at the moment. So it's a sector personally that I would be avoiding. Even in Australia, the bluest of blue chip stocks in Woodside is down by well over 50%. And that would have been recommended as a staple part of any portfolio in recent times. On a bigger picture level, and for a whole bunch of reasons I won't get into, but we're entering a stronger period for commodities. Now that's a bigger picture statement, so that's over the next 2, 3, 5, 10 years. Iron ore and gold are holding up really well for now for their particular reasons. Iron ore because it's expected that China is going to stimulate massively, and also gold for the reasons that I've discussed. But don't lose sight of base metals, copper, nickel. Not now, because demand is going to be punctured for some time. But in a couple of years' time, the situation for copper and nickel is going to look pretty good. So they're a story for another day, but don't lose sight of them. There's the spot copper chart, so it's absolutely fallen off a cliff. There's the nickel chart, has certainly come back, but not quite as meteorically, and that's largely because of the Indonesian ban on nickel exports has softened that situation for nickel. So to wrap it up, you've just got to be really clear about your targets. It's a simple message, but it's just so important. Are your targets stocks that have held up really well and they look like strong businesses going forward? So are they like the A2 Milks and the Fortescues and a handful of others, so that they can be targets? Are they large cap stocks in sectors that have got tailwinds? So that is particularly in technology. So are they stocks like Apple and Microsoft, etc.? Or are they smaller quality growth stocks that have got strong balance sheets and really robust cash flows, so they're going to be able to get through to the other side of this? Now, they've all been absolutely smashed. And if you look at something like Afterpay Touch, I mean, the price fluctuations in that have just been absolutely immense. And I'm not saying that Afterpay Touch is a stock that will get through, but the ones that have the balance sheet strength and the cash flows to get through are going to experience extraordinary percentage rebounds. So all of these targets have got a potential place in your game plan, but you need to just sit down and think about it and decide what the relative proportions of each one of these are that is going to be appropriate for you, and put together a game plan. It's just something you've got to do. And I know that human nature doesn't want to do it, because you sort of feel like you're putting yourself in a straitjacket if you make decisions. But it is really essential. So you've got to be very clear about your target. And then the second thing you've got to be very clear about is your process. How are you going to enter? What are the signals that you're going to use? What are the time frames that you're going to use? Are you going to take quick profits on big percentage rebounds? Or are you going to get out of things completely? Are you going to take partial profit? How will you go about staying on top of the larger picture? These are all questions that you need to address. Will you employ any hedging? So when we get a rally, you've still got exposure. Will you put in place some hedging by buying put options or inverse ETFs or whatever it might be to smooth out the volatility? You need to make those decisions now. You don't want to be making those decisions on the run because your emotions will just be too engaged. You need to avoid factoring in worst case scenario because it almost never happens. And if you factor in worst case scenario, then what your subconscious does, it just shuts off your opportunity or your tendency to look for opportunities. So, just don't do that because it's not helpful. Portfolio analyst this week, it's just more of the same. It's reorganising our portfolios to a new environment, knowing what our targets are, knowing what our game plan is, and just being prepared. So that's it for this week. There's my contact details for any non-members, and I'll do my best to to keep you updated with the broad picture. And of course, members will get a far more detailed picture. That's it for this week. Cheers.